All right. Good morning, everybody. Good morning. All right. Good morning, everybody. Sorry. I gotta do this. Good morning.
Good morning.
All right. Good morning, everybody. Sorry. I gotta do
Good
this.
morning, engineer.
Good morning.
All right. We're here. Good morning once again. Welcome. I'm sorry. I don't know why I woke up late. It's a confession. I was awake for almost 2:30 a.m. So, all right.
Okay, let's go ahead.
I'm telling you, I was awake for almost 2:30 to getting to 3 itself. I was doing something. I make sure what I'm doing, I finish it before I get to bed. All right. So, we stop at chapter 4, I think. Did any person? Did any new person join us here? IJ Okonkwo. IJ Okonkwo. Good morning.
Good morning.
Yeah, you're welcome. Is it your first time coming here?
Yes.
Oh my God. You're welcome. Who is your business partner? Sorry.
Pat, Miss Pat, Osoji.
Oh, sorry. All right. So you're welcome. This place, there's no teacher here. All of us are teacher. We are trying to, I'm just a moderator. We are trying to get this in, make it PCC so that everybody will be able to understand it, make it easy. So it's a suggestion class where you can, it's interactive class. So if you feel that something is not all right, you say it so we can get it hold on and so everybody can move on. So please, we need your contribution. Contribute however what you can. We are trying to bring the terms, break it down to the level that everybody understand. The intention here is for everybody to go to that hall. So,
okay, thank you.
So that is the intention. We want everybody to go to that hall and pass because this exam is not difficult. It's just because me and you, nobody have time. Everybody's busy either with work or family or this or that. So, but in this review class, we are making it intentional, so that that person can be able to pass. I hope you have registered for your exam. Most importantly,
Yes.
here people have right.
Next week. I have it next week.
Oh, all right, that's good. So now you see that you've been intentional because your mind is that I have that exam. Apart from that, read on your own too. Read on your own. You have Excel solution or FX solution. Which one do you have?
Excel.
Excel. All right. So read as we are going. Read like we're now on chapter 4. We finished the whole thing before. Then we started again. We were doing it until we are now on chapter 4. So you can go back and get yourself acquainted with all these ones. Chapter 1, 2, 3 we have done. While we are going forward, as you follow us with chapter 4, you still go back to see whether you can get those things back. So which state are you calling in from?
PA.
Texas?
PA.
All right. Pennsylvania. All right. So since you have Excel solution, go to if you open up your Excel solution, you see what you see here, Texas Life and Health Pre-Licensing Exam. You see it?
Yes.
So your own will be Pennsylvania Life and Health Pre-Licensing Exam. That's what you see on your own.
Okay.
So for you to read your state laws and rules, you see this place I highlighted? You see this place I highlighted? Just click there, download it. It's gonna tell you everything about Pennsylvania. their laws, the state laws and rules, to tell you everything about that. Yeah, so read it. Because this exam is in two parts. One is the national. What we are doing now is the national. It's made up of 110 questions. Then the state is 35 questions. So for you to pass, you have to do the national and do the state. If you do only the national, even if like get 110 over 110, you're still not gonna pass because they want you to know also your state laws and rules. So your state laws and rules are very, very important. The good thing about it is that most times it's not on review question, it's only a straightforward question, questions that you can answer easily. So just go through it.
Sorry, I have a question.
Go ahead.
Yeah, you said there are two exams.
The exam is in two parts.
But the same day, the same you taking
Yes,
at
yes. Yeah, the same,
okay.
yeah, the
One
same day.
sitting. Okay.
Yeah, so but the only thing is that when you finish the first section, which is the national, is made up of 110 questions, they will ask you one question whether you want to, they will say you are now done. Do you want to continue or not?
Okay.
If you say you don't want to continue, they're gonna log you out and you fail. So just say you want to continue
Okay.
for the second section, which is the state. So when you finish the state review laws, you come down to the last part of this Excel solution review. You will see, come down, you see here, you see Texas Life and Health Insurance laws and rules. Did you see it?
Mm-hmm.
Yeah, you will see in this particular one, you see Pennsylvania Life and Health.
Yes, I've gone
laws.
through it.
Yeah,
I've gone through them.
all right, so that's good. Then you do the exam. The exam is down here. All right. So you're welcome.
Thank you.
So we're gonna go back to chapter 4. We may actually finish chapter 4 today. From the way I see, we may finish chapter 4 today. All right. Please, who is Big E's? Big E's. Good morning, Big E's. I've not seen this before. Who is Big E's? Big E. Is iPhone?
It's Ifiak.
Ifiak, good morning. Is this the first time?
No, I've been on here for 2 weeks now, I think.
All right.
Time.
All right. All right. I've not seen that. All right. You're welcome. So we're back. All right. Chapter 4 is about policy types. Remember, I said policy type. In every type of insurance, there is always a policy type attached to each type of life insurance. For instance, if you talk about term life insurance, there's policy types attached to term life insurance. If you talk of whole life insurance, there's policy types attached to it. So there is difference when somebody say policy type and types of life insurance. So in every type of life insurance, there's always a policy types attached to it. And apart from the policy type, we still attach to it what we call riders. Like who can remember? We did term life insurance. Who can remember the types of policy types in terms of term life insurance? Anybody remember?
The increasing term, decreasing term, and level term.
Correct. So these are the policy types in term life insurance. All right. So that's it.
So did I get it right?
Yeah, that's correct. Yeah.
Okay.
Yeah, that's correct. We have is only three of them. So if we go to whole life, we're still gonna get the policy types in whole life. So when somebody writing policy, let's assume a client say, I need to write term life insurance. It's left to you based on the need analysis you performed. You will now tell the client, say, look, I have there's decreasing term, there's increasing term, there's term. Which one do you think that is possible? However, you have to determine that by an analysis. Somebody cannot just write life insurance without knowing the reason why that person need a policy. There must be reason why somebody need a policy. Based on the need, you can be able to tell the person on the type that fit his needs. That's why the education is necessary in writing policy. There's no way you can write policy and write it correctly without you knowing what you're writing. No, it's not done. So there's need for you to understand what you're going to write. That's the reason why you're here. So in this review class, actually, we are not only trying to get you to pass the exam, but we are trying to initiate you into understanding what all those policies are and the need of them for your clients or your customer. The need for them to have it when necessary and when they need it, based on their own family need analysis. So it's not only just writing policy, no, far be from it. You have to understand the needs. If you don't understand the needs, it will be very difficult for you. And even you have your own policy. Now that you are here, you're going to be able to understand those policies you did, why you need them, and if there's any correction you can make. Of course, the contract, because the contract is not binding, you can no longer make any correction on the contract. So what that means now is that now that you are on it, you can be able to write another policy if you can be approved. Because it's a question of time. The older you become, the difficult is for them to approve you. And more especially when there is any health concern. So, and there is no how somebody will continue to be old without having a health concern. I have never seen that. Somebody who is old, as somebody ages, health concern must crop up. There is no about that. When somebody who's 20 years and somebody who's 50 years, their health condition may not be the same. Except that person is so lucky that at 50 years, 60 years, 70 years, you are still strong. Good for you. But the
Because just 1 out of 10.
average is 1 out of 10. So that is why life insurance is good to do on time. If you can, the best thing to do it is now, not today, not even today, now. And it applies to our children. Because as it is to us now that some of us cannot be approved based on health concern, our children who are very, they are sick claim. So this is the best time for them to have policies, no matter how small it is, no matter how small it is. If not, in fact, you can even avoid doing bad there for them and make sure they have policy. No matter how, they will thank you when they grow up to see that they have policy instead of bad day. They will thank you. After a bad day is continuously, we can celebrate it continuously. So, and even going to McDonald's, we can see, if we're going to McDonald's twice in a week, we can say maybe once in 2 weeks. It's our children, whatever we tell out their mind is what they will do. That is the truth. If we go to McDonald's with them twice in a week, they will see it as a routine. But if we go once in a month, they know that it's everything once. Their mind will shift out of it. So, the children, most important, they need it now. They need it now. The children need it. Because there'll be a time they'll be like us. And again, going to clinic with the children is another thing that everybody should understand. You have to be able to know what is in the medical record of your children. Some people will go after coming out from the clinic, they see different things. I have been a part of it. I told you guys the experience I have. After going to clinic, the next day I logged into my chat and found out that they tried high cholesterol for me. I said, me, high cholesterol? I go to the last lab, which I did 2 weeks, a week before I go for the annual medical checkup. A week. And I checked the cholesterol. It was fantastic. I said, why did this lady write high cholesterol? I have to go back there. I have to go back there. I asked her, say, look, why did I see high cholesterol? He said, oh, it's for their own medical billing. I said, what? But it's to my own disadvantage, because definitely if I'm gonna write anything policy now, they will see it as I had high cholesterol. So that's how it is to everybody. When you take your children to hospital, please find out what is in the chart, because that will prevent them from being approved for insurance policies. Check. Don't just go. And after treatment, you pay them and go home. No. Sometimes they will add something to make sure they bill. So that's what everyone has to do. All right, I think we stop at is it renewable term or what? We remember. Junior, did you remember?
We are done with term insurance now. We are moving to whole life.
Oh, we're moving to whole life. All right. All right, we did convertible.
Permanent whole life. That's where we are going now.
All right. Yes, you're right. All right, permanent life insurance product. I think the Bible said by their word we shall know them. Is it the Bible that said that by their word we shall know
by
them?
their fruits, shall know them.
By their fruit we shall know them. So life insurance, term life insurance, by their fruit we know the name. By the name we already know what it means. Term means that what? It's for short period. It's not permanent. The permanent life insurance what means what? It's for permanent. Of course, some of them, like whole life, is designed to last for 100 years. So at 100 years, you're no longer going to pay premium on it because what? The first amount is equal to the cash value. So most importantly, permanent life insurance has cash values attached to them. What we mean by cash value is like when you pay your premium is channeled to several ways in managing your policy. Part of the premium goes to the insurance cost of insurance. Some go for administrative fees, some go for commissions, and all others. So in permanent life insurance, when you pay your premium, some of the, part of the premium is channeled to what? A portfolio called cash value. So if they will divide the premium, some parts go to the cash value, some parts go to administrative fees, some goes to cost of insurance, some go for reserve. So the part that goes to cash value is the part that work for us. So that is why in term life insurance, we don't have what we call we don't have cash value because there is no when they divide the premium, there is no one assigned to cash value. So based on that, in permanent life insurance, we don't have what we call return of premium riders in permanent life insurance because the cash value has been divided and one assigned to your cash value. So the cash value continues to compound and make profit for you, add to your policy. So that is one of the good benefits of permanent life insurance. So we're going to dive into permanent life insurance to see different types of permanent life insurance and different policy types. Different types and different policy types. In each type attached so many different policy types, just like in term life insurance, where we have 3 principal policy types. So in permanent life insurance, we're going to go into it and see the policy type that we have there. When you talk about permanent life insurance, we're mostly talking about whole life. Because the basis for permanent insurance contract is whole life insurance. We're talking about permanent life insurance, we're talking about whole life insurance. And one good thing about whole life insurance is designed to what? To last for 100 years. And when we say 100 years, 100 years, you do no longer have to pay premium on that policy because what? The cash value, that part of the premium that goes to the cash value is now equal to the face amount. The face amount is the amount you bought. If let's assume you buy a policy of 500,000, your face amount is 500,000. That face amount is equally called the death benefit. It's equally called the face value. So face amount can be called death benefit or face value. 3 names. So please have to know the 3 names so you not get confused. So whole life insurance what ensures death benefit or face amount is paid upon the insured's death. Of course, when somebody buy a policy, one of the reasons why we buy a policy in those days, not now, honestly, in those days, not now, is because we believe that when we pass our beneficiary will collect some money. That's one of the reasons why we were buying it in those days. But actually, yes, it's still one of the reasons now, but it's to us who want to live, eat while we are still alive, does not actually believe that it's only when we die. So life insurance has gone out of that phase of, oh, it's only when you die. That is our community understanding about life insurance. When you die, your beneficiary collect money. I think collect benefit is no longer there. It's no longer like that now. We're talking of when person is still alive and be part of the benefit. And that is what's pushing everybody into it. You see that it becomes very, very important and necessary for everybody to have one. So whole life insurance ensures a death benefit of first amount is paid upon the insurer's death. Who is the insured? The insured is you. The insurer is the insurance company. So no matter when it comes or when it happens, when that person died, even if you buy a policy today, everything is done to that, is approved, and you have paid your premium. And tomorrow the person passes. What happened? The insurance company is going to investigate, and they must pay the benefit. So because of life insurance is a contract of unequal value. Can anybody remember what we call it? Contract of unequal value. Aleatory. So please, everyone should know that sometimes we see it in the exam. Aleatory life insurance contract is a contract of aleatory. Means that is what contract of unequal value. Why is it called unequal value? Because if you buy a policy today and the next 2 days the person passes, if you buy a policy of $1 million and the next 2 days the person passes, probably maybe say accident or anything at all. Or maybe if you're diagnosed of any disease, waiting these 2 days, I mean, after the 2 days, definitely life insurance is going to step in to be of help. If the person passes, yes, they're going to pay the death benefit. If they found out that, look, the person does not have the sickness before the policy was written, they're still going to pay you the benefit. That's why it's called, say, life insurance contract of unequal value or aleatory contract. So this policy offers lifelong protection, covering the insured from instant death until their passing. Of course, that is whole life. Whole life is trying to last for only what? 100 years. And I don't know how many of us will pass 100 years. It's 1 out of 100, or two, maybe, let's assume, well, if we bring 100 people now, how many people will reach 100 years? Maybe 30. I don't know. 30 over 100 will reach 100 years. So it's designed to up by 100 years. In that 100 years, from 100 years, you're no longer going to pay premium because the target of getting up to first amount, I mean, cash value has reached. The first amount now will be equal to the cash value. Remember what it takes. The part of the cash value that is given, that was assigned, part of the premium that was assigned to cash value, for it to have built to the extent that it now becomes equal to the first amount. You know what it means? It's not so easy. And again, that will tell you that there is always increased factors that's related to cash value. So tell me why you should not go for a policy that has cash value. Just imagine in your mind that this part of the premium you paid, not all of them, part of it, small percentage of it, is now assigned to be building up as a cash value. Now, the other part is now used for different things in your policy, such as your cost of insurance, such as administrative fees, such as the commission of the agent. So if some goes to a reserve, company reserve, for payment of claims. So the small part that we keep for cash value will now increase until you get to the first amount. Did that tell you something that that will show you there is a massive increase? Compare it with the increase you get in your banks when you put money in a bank. Just picture it a little bit on your mind. The one you put on your back and the one you use to buy policy, which of them increases more? So it's just picture it in your mind. You see that that thing has a lot of great increase. So whole life policy are also known as straight life. Whole life policy are also known as what? Straight life, continuous premium life, permanent life or ordinary life insurance. So it just like we have in term life insurance, we have level, decreasing and increasing. In whole life is also known as what? Straight life, continuous premium life, permanent life, or ordinary life insurance. So a whole life policy is generally described as fixed death benefit, fixed premium life insurance contract. So it's a fixed death benefit because the death benefit is already known. It's predetermined during the contract. It's fixed premium life insurance contract because the premium you're going to pay is already known, and that's what you'll be paying throughout the life of the policy. So that brings us to issue of we making sure that our children, particularly those who was even born today, have a policy. If they have a policy, $2 million policy, and they are paying probably $100, $200 monthly, that is exactly what they'll be paying throughout the life of that policy. It's not going to change. It will not change. Then you too, at your own age, you go and buy and have a policy. The premium you paid, you're going to pay is what you're going to pay throughout the life of the policy. That's why they say it's fixed premium life insurance contract. The death benefit is fixed. Of course, if you purchase 500,000, that is the death benefit, and that is the face amount. That's the face amount or face value. So these are the things you need to know. Now, in other words, it is whole life is what is characterized by what? A level death benefit. Of course, we know that a cash value, a cash saving values, which means equity build-up. Equity build-up in the cash value. There's equity build-up. Permanent protection and a fixed level of predetermined premium. So these are the characteristics of whole life, which is permanent life, which is straight life, which is continuous premium life, which is also ordinary life insurance. So these are the things, little things that get people confused. When you hear of whole life, they are equally talking about permanent life. They're talking about what? Ordinary life insurance. They're talking of continuous premium life. They're talking of straight life. Continuous premium life means that the premium is continuous, does not change. Straight is leveled. All right. So this build-up, equity build-up in the cash value savings is what triggers people to embrace, always seek for whole life or permanent life. And of course, the permanent protection it gives to people. You know, we keep on saying that life insurance is not an investment. It can never be regarded as an investment. It's a protection portfolio. When the time we are talking about annuity, you can see that we use a lot of investment as a word to describe annuity. But in life insurance, we do not do that. Life insurance is not an investment. It's a protection portfolio. It's not an investment portfolio. But however, when you come to understand it, you see that it can equally help you, at least for your retirement. So, but the law says life insurance is not an investment portfolio, is a protection portfolio. Remember, if life insurance becomes an investment portfolio, it will remove all the tax advantages. Now you'll be taxed on it. And when you're taxed on it, somehow become MEC, modified endowment contract. I hope everybody remembers that.
Yeah.
All right. So the death benefit, premium payment, and the interest rate paid on the cash value are all determined for the insured whole life. Also, a whole life policy protects insured permanently for the remainder of their life. This life insurance policy never needs to be converted or renewed since it remains in force as long as all premiums are paid on time. You can see why permanent life insurance is not renewable. It's continuous. unlike term life insurance, renewable because they give you number of years, specified number of years. Term can be 20 term, it can be 30 term, it can be 15, it can be 10 terms. Means that at age 10 years, it will term. At that 10 years, you will renew it. If you don't renew it, you lose it. And there is tendency that a renewal, the premium you are paying definitely is not going to be what you're going to pay. The premium you are paying from the time you bought the policy will not be the premium you're going to pay when you renew. There's an increase when you want to renew. So based on that, term life insurance, to me, I see it to be the most costliest insurance. But everybody will see it as what? Some people see it as being the cheapest insurance. Of course, that is one of the advantages it has. It's cheap. Of course, $10, $15, $20 monthly. But what happened at renewal? What happened at renewal? If you have 30 term, maybe you maybe 30 years or 30 years or 40 years, you have 20 term life insurance. Let's assume you have 40 years, you have 20 term life insurance. When you turn 60, you're going to renew it. And if you are paying $100 from the time you bought the policy, from that 40 years when you bought the policy, and you get to 60 years term, which is 20 years term, what happened? You have to renew the policy for the policy to continue. If you do not renew it, the policy will go, will terminate. So when you renew it, you expect to see different premium, not that $100 you are paying, because the new premium now will be based on your new age, which is 60 years old. And at 60 years old, you should expect that premium to be more than $400 to $500 or $600 because it's based on your new age. So to me, I see it as not being as cheap as people said it is. But the general notion is that term life insurance is cheap. Of course, it's cheap at the initial time, but as it goes on, remember, as you grow old, your cost of insurance becomes higher. So that's why at 60 years, you're not going to pay the same premium. So why not get the one that you can pay the same premium throughout the life of the policy? You don't need to renew. You just need to continue. And moreover, it has a cash value attached to it. So there's so many things that our people will consider. Our people have become victim a lot, and even me, I'm part of the victim. I have term life insurance, which I wrote around 2007. But if I had known, or if the agent who gave me the policy or who sold the policy to me explained to me actually what it means, I don't think I would have fallen a victim of going to get term life insurance instead of getting the real deal. So that will be part of the education you're going to provide to the community in which we are. All right. Also, what a whole life policy protects and insured permanently for the remainder of their life. When you buy whole life, you have bought it for life. This life insurance policy never needs to be converted or renewed. You do not renew whole life insurance and you do not convert whole life insurance. Remember, you can renew term insurance and you can convert term insurance to whole life or permanent life. You can convert term insurance to permanent life. You ask your company, have term life insurance, ask your company whether you can still convert. Some of them will say after some years, you can no longer convert term to permanent life insurance. Since it remains in force as long as all premiums are paid on time. So whole life remains in force. It cannot terminate except what? You did not pay your premium. There are so many reasons why they will terminate it. That whole life can be terminated. It depends. One of them is when you must have committed fraud. Of course, we're going to see through them what we call contestability period and non-contestable period. We're going to see it. Now, features of whole life. What makes whole life very good? And what makes whole life people's admiration? People want to have it. One of them, it has a face amount death benefit that is known, fixed. It has a premium that is level. I want everybody to look at this graph. Look at this age. This age is the policy issue, which is the starting. We call this rate 0. I hope everybody's seen my graph. Yeah, everybody's seen the graph. So you see that at this line where all the lines join itself is 0. That is the age the policy was purchased. Let's assume somebody bought policy today. Now, this place, all the lines joined together is 0. That is the age policy was issued. Now, that policy will go on to age 100. When you buy the policy till when you get to 100 years, this policy will have a level premium, which means the premium you are paying, if you are paying $200 as your premium, it remains the same. It does not change. That is the characteristics of whole life insurance. The premium remains the same, it does not change. Now, you see the increasing cash value. The red line that goes up, that is the increasing cash value. The cash value is increasing. That part of the premium given assigned to the cash value is increasing. It's generating some cash, is increasing. Now, the first amount of the death benefit, the first amount is the amount of policy you bought. That first amount is there, it's remained the same, it does not change. What is changing? The cash value is increasing. So remember, you can do so many things in this cash value. You can borrow against the cash value. You can take loan against the cash value, because this cash value is what we call non-forfeiture. It's just a give back to you, the part of the premium that is given back to you. So this cash value is not forfeiture. In case if you decide tomorrow that you do not want the contract again, you want to terminate the contract, this cash value will be given back to you because it's your money. It's a part of the premium given back to you. So this is just the features of whole life insurance. If you understand this, it will help you to answer so many questions. Any question here? Any question? All right. So all types of whole life insurance share certain features, and that's the features. The traditional whole life insurance policy combine pure death protection and the cash value features. Pure death protection, which is the death benefit, and cash value features. In fact, the most wonderful thing about whole life is the cash value features. If you put the cash value features, then you have everything. Imagine you going to your policy to borrow some money. Imagine you going to your policy to take a loan. So that is the features you have in whole life insurance. And that have cash value. That's why everybody's in it. So additional, the policy is death benefit, which is the first amount, remain constant or level throughout the life of the policy. The first amount does not change. Premiums are set at the time of policy issue and remain fixed for the policy life. Any amount they said that is what you're going to pay monthly, or that's going to go pay annually, or that's what you're going to pay every 6 months, depending, because remember the premium is flexible. You can pay monthly, you can pay annually, you can pay semi-annually. So that's what it is. Now, premiums are set at the time of the policy issue. When the policy is being written down, is when the premium is set up. Whole life policy are based on the what? Assumption that premium will be paid by the policy owner throughout the insured's lifetime or at age 100. What does that mean? It means that whole life policies are designed to mature, endure at age 100. So we use the word endure at age 100, which is mature at age 100. Whole life matures or endures at age 100. When the policy matured or when it endured, the first amount will be equal to this cash value. So you can see that at this point where the first amount and the cash value meet. And if you bring it down, you see that it matches with the age 100. What it means now is that this policy has endured or this policy has matured. So at this point, if you are able to live up to 100 years, you can no longer pay premium. And your policy is there. So you can see the numerous advantages attached to whole life. So if you have this education, you educate your clients or your customer like this about whole life. Now educate the person about term life. The person will make an informed decision based on what education you have provided. So whole life policies are designed to mature or endure at age 100. Many never Many new whole life policies now endure at age 105 or 110. Of course, they're even trying to get new ones that can mature at age 105 or 110 because I think people are beginning to live longer. That's why the retirement age has increased. I think 70 now. So people are concerned about the cash value and the endowment, that is the age of maturity. That's what people are concerned about. So people get excited to see that it mature at age 100, you know? Even though not everybody will be up to that age, but people are excited that you don't need to pay, say you are going to renew, you are going to convert. I converted group life to group life from my workplace to individual whole life with cash value. It was, well, in fact, I don't know whether 100 times times of the money I was paid. It was on the high side. So it's just the same thing when in fact, the group life you have at work is just term life insurance. It's term life insurance. But they don't want to give you that name. It's term life insurance. The only thing different on it, in fact, it's just term life insurance because there is no evidence of insurability. When they want to have your job, they come to check your lab? No. They just put your name, no matter the risk you have. So when you come out now, you want to convert it to individual whole life, there will be no evidence of insurability because of COBRA. You're going to convert it, but what they're going to catch you, because it's now based on your new age, you're going to catch you with the premium. So cash value and endowment or maturity are the main features that distinguishes whole life insurance from term life insurance. Of course, well, I've said it, the cash value, the presence of cash value and this maturity age is one of the things that make people go for whole life. All right, let's look at this example tip. It said, quiet term life is designed to provide temporary protection if the insured dies too soon. Whole life insurance is designed to provide permanent protection when the insured dies. So why must you go for the one that provides temporary protection than to one that provides permanent protection, even when the person dies? So these are the education you're going to give the person, their customer. After giving him the education or ever giving him or her the education, then he's going to make informed decision. Whatever choice he made then will now be based on his knowledge, not based on he just want to buy policy. You cannot just want to buy policy because you want to buy policy. There must be a reason attached to it. And that reason will be based on their needs. So you buy policy based on your needs. Do you want a temporary protection? Yes. Term life insurance provide for you. Do you want a permanent protection? Yes. Whole life or permanent life with whole life insurance or permanent will give you a permanent protection. So it depends on you. Whichever you want is there. Remember, in this whole life, we're going to move ahead to see different types of policies that you can get from whole life that will benefit you more. And all of them, fortunately, all of them have cash value attached to it. So we have discussed about cash value. We say cash value is part of your premium. Let's go a little bit and see. It's unlike term life insurance, which only provide death benefit, permanent life insurance combine insurance protection with savings elements. Did you see them talk about investment here? No. Permanent life insurance have what? Give you permanent protection with element of savings element. And what is that savings element? The cash value. And how did that cash value come? It comes from the premium. The bit of the premium assigned to that saving element, which is the cash value. So the accumulation of fund or equity, commonly referred to as the policy cash value, builds over time, over the life of the policy, although it's an essential part of funding policy, the cash value is often considered a living benefit because it represents the amount the policy owner will receive if the policy is ever surrendered or voluntarily terminated. So you do not lose at all. See one good thing about whole life. You don't know, even if you decide today that, look, you have the policy, maybe you have 500,000 dollar policy. You are contributing to you are paying their premium for almost 2, 5, 6, 7, 8 years. And at the point you see that you can no longer pay, cash has gone out of you. You decide you want to terminate. What will happen? That is, you voluntarily want to terminate. They're going to give you this part of the cash value. This part of the cash value is your money. They will give it to you. Now, take yourself to term life insurance. If you decide you want to terminate, you're not going to get nothing. Even during the renewal time, if you cannot be able to renew, you will not get nothing except you have return of premium rider attached to the policy. So if you have a term life and you do not have return of premium rider, when you decide to terminate or when the policy terms, you couldn't be able to renew, nothing. You're not going to get nothing. 1 cent you will not get. So these are the indications necessary for our community to know. All right, so that is it. You now decide, can I buy term life or can I buy whole life? With these features, you'll be able to make a informed decision on what to do. You don't want to go live where you have saving elements to go where you do not have saving elements. Although everybody have, that's what I said, it depends on the needs. Some people want a temporary protection. Yes, give it to them. And when you get your license, you can sell permanent life insurance. You can equally sell term life insurance. You can sell any of them. But you have to give your customer, provide to them the education they need to make an informed decision. That's the only thing you need to do. So although it is what an essential part of funding the policy, the cash value is often considered a living benefit. Who doesn't like a living benefit? Most of us don't like death benefit, though. I don't like anybody here like death. I don't know anybody here like death benefit. Like when you die, of course, when you die, you don't know who benefits or who does not benefit. But however, based on the knowledge we are gathering today, and based on what we are doing today, we already know how the benefit, if we are no longer here, we already know how everything will go. And that's exactly what you want to know. You want to know what happened when you are no longer alive. I think that is the best thing anybody can do. You want to know what happened when you're not alive. And for you to know what happened when you're not alive, it depends on today, what you do today. We give you that. You can reposition everything you have and you know exactly on whom it's going to. Yes, you can do that. You can guide their weight. Even if you are no longer here, it becomes difficult for intruders to go into it. Yes, you can do it with the experience, with the knowledge we're gathering today. You can do that. You can lock it. Tell them when and at what time it will be released to anybody. If you have a trust, it solves the whole problem. Whoever becomes the trustee, whoever will be the manager who manages the trustee, will be the person that will be in position. However, what is in the trust is what the trust company will follow. Any instruction you put there is what they will follow. So if you have made all those money, you could not be able to keep it in order. History has led us to know that it takes them 6 months to 7 months to vanish, to finish up the money. Just like somebody who wins lottery. The person who wins lottery in the next 5 years will go back to begin to beg, go to the street to look for money. So the education we need here, we are doing here is quite necessary to us and to our family members. So when the policy owner pays the premium for a whole life insurance policy, what happens? A portion of that premium is used to pay for the death benefit. This portion of the premium is referred to as the term insurance cost or the mortality cost of the insurance. Of course, remember, when I said when you pay your premium will be allotted to different channels. One goes to your cost of insurance. Another one goes for expenses around the insurance. The third one, reserve. We have the fourth one to the cash value. So the one that goes to pay the death benefit, to pay claims, is the one for death benefit. Is the one you are paying, is that what you're going to pay the death benefit the person passes? I don't think so. When the insurance company have a particular reserve where they put all this premium for waiting for any claim to come up. So you are paying, I am paying, she is paying, everybody is paying. When everybody is paying, so part of the premium of everybody is sent to that reserve for claim payment. Goes to claim payment, some goes to the reserve. The one that's going for claim payment, if any claim come up, that's where the life insurance company will go and take money to pay the death benefit. And what they call the portion that goes to the death benefit or the claim is what it refers as term insurance cost, or is the mortality cost of insurance, the cost of the insurance. So another portion of the premium is used to cover the cost associated with the insurance company that issues the policy. Of course, definitely they're going to do a lot of things. They're going to do that part to pay your commission. When you pass your license and begin to do business, you'll be receiving commissions. So some part of the premium paid will go as a commission. Some part will go for underwriting principles, Some go for medical exam. Remember, they will send some people to come and see, to come and check your blood. So some of the premium goes to a medical exam. And some goes for maintaining the policy, of course. So after the contract has been effective in an initial period, the insurer begins depositing a portion of the premium into the policy value, cash value. So immediately you pay your cash value, immediately you pay your premium, the one going for your cash value, your automatically go to the cash value. So I don't see the reason why people should not go for this. You have an element of savings. Let's go for it. So look at this step. As you pay if your policy is active, as you pay your policy, your cash value continue to increase the step. You see the step going up, continue to go. So that's element of saving attached to whole life. I think we have on that. Any question on cash value? We're gonna jump some things so we can move forward. Any question on cash value? All right, there's one thing I want to tell everybody about cash value, the growth of this cash value, and the amount you are paying. Most times, some agent will tell you to pay annually. Yes, if you pay annually, what does it do? The accumulation becomes faster. You pay monthly, what does it do? The accumulation is very, it grows like a tortoise. But when you pay annually, it runs fast. Of course, they will say when less money being used for actual insurance protection, more of the premium can go towards growing the cash value during the later policy years. Whole life insurance policy, we are traditionally designed so that their cash value built up will equal the policy first amount by the time the insured reaches the age of 100, of course. So let's look at this. We just analyze this and go forward. Look at this drawing. It's an insurance protection required versus cash value accumulated. Look at the insurance protection at the left side with red. Look at the cash value. So as you continue to pay your premium, this one is building up. As your premium is building up, so as your money you are paying is increasing, which means if you increase your premium payment, your cash value will increase. That's why some agent will tell you, please fund your policy well. When you fund your policy well, what happens? You build cash value quick, which means the more you have cash value, the more, if anything come up, you can go there to get what? Get some loan or get some withdrawal as you may like. And if you now surrender the policy, you still have that cash value back to you. So the more you fund your policy, the better for you. If you pay the least of the premium to hold the policy alive, you're not generating any cash value. Some people come and design the policy and show you that you're paying. Somebody wrote 500,000, 200,000 life insurance for you, and the person say your premium is 500. Another person come and wrote the same $200,000 policy for you and tell you that your premium is 200. You agree on 200. However, the person that wrote say you pay 500 have made it designed in a way that your cash value inbuilt will be more. Then this person just said your premium is 200 and you're paying 200. You say, oh, his own is cheaper. His own is not cheap at all. He didn't tell you the right thing. You are getting less on cash value. Yes, you are the saving line on the cash value is less. You are not saving. You are just trying to maintain the policy alive, but nothing is coming out of it. It's gonna take you some years before that policy can be able to begin to generate cash value for you. So that's why if you pay lump sum payment, you can in the next 1 week can start to withdraw from money from that policy. Particularly, you can take a loan and can make a withdrawal from there because the cash value has already built on it. So it's very important for you, all of us, to understand traditionally this whole life. The cash value build-up is not paid to a beneficiary in addition to the benefit when the insured dies. So it's important for everyone to understand it. As an agent, it's good for you to understand it. That the cash value is your money. So what do? The best thing you do is to, when you see is that getting to too much, have to go there and take money to solve your problem. Because what they're saying here, they may not give you the cash value and plus the death benefit to your beneficiary. So use your money. Use it while you're alive. In fact, they keep that one for you to use while you're alive. So use it as you're alive. Somebody can go to his life insurance policy and take money and buy a home. Of course. All right. So the policy cash value is available to policy owners at any time. Did you see it? The policy cash value is available to you at any time. The policy owner always have the right to policy cash value. The policy owner can surrender the policy, cancel coverage, and receive the cash value. You can, at any time you like, you want to cancel the policy, you can cancel the policy, you receive your cash value. So let's assume we are 100 years. You can cancel the policy and receive your cash value. The cash value now becomes equal to death benefit. Yeah, you can cancel it at 100 years. 100 years, you cancel it, you have your cash value, you receive your cash value. You're still alive. You cancel the policy and receive the cash value, which is equal to the death benefit you bought for. So this is why the cash value is also referred as the cash surrender value or non-forfeiture value. Did you see it? Why I always refer cash value as non-forfeiture value or cash surrender value? Because it comes to you if you decide to cancel the policy. At any time you cancel the policy, that part of the cash value will be given back to you. So it is the amount the policy owner will receive if they choose to surrender or forfeit the policy. The cash value accumulation also provides policy owner with what? Opportunity to borrow against the policy equity while keeping the policy in force. So the advantage on whole life is so massive that you don't need to ignore it, honestly. The borrowing of policy cash value is considered a loan, and as such, interest is charged on it. Yes. Can interest be charged on the loan? Of course, yes. But however, if the interest is charged, who is paying the interest? You. Who are you paying the interest to? Yourself, because the cash value belongs to you. So if you decide to go and borrow from your cash value that you are paying interest on it, there may be 1%, 2%, or highest. I know highest are paying 2% interest. Can you compare that you went to your policy to get money to buy money to buy a home and paying 2%? Can you compare it when you go to the bank and borrow money and be paying up to 7-point-something%? And who are you paying that 2% to? Yourself, because that money belongs to you. What if you decide not to pay? Of course, if you decide not to pay, if the person passes, they're gonna get it from your death benefits. However, if you decide to pay, it's your own. So this is what we do not want to miss. All right, let's look at maybe this will help us to understand it well, because we need to understand this well. Let's look at this application scenario. Let's look at this. Maybe after that we go. He said, at age 30, John is 30 years, and John buys 100,000 whole life policy for 1,200 per year, which means the premium he's paying is 1,200, 1,200 a year. Invariably is $100 monthly. So, but John is paying 1,200 paid at once per year. So it takes about 3 years to start building a cash value. He is paying 1,200 at the same time. So it takes about 3 years for him to start building a cash value. And the intention of Mr. John is to build a cash value. That's saving aspect of the whole life. That's what John wants to enjoy. And for him to effect that immediately, he start paying yearly, which is 1,200. So it takes him 3 years to start building cash value, which is the target. So by year 10, the policy was 9,000 in cash value. So at 10 years, he already has 9,000 there. Are you telling me that if Mr. John go to the bank today to be depositing $1,200 every month, are you telling me that at 10 years, John will be able to have 9,000 cash as an interest? Can John get up to 9,000 cash? Anybody?
No.
He can't get up to 9,000 cash. 10 years, he's paying to every year, he's depositing 1,200. Every year, he's depositing 1,200. After 10 years, John can now get up to $200, $300. And however, the banks will turn around, carry this money John is depositing every year to go and invest in life insurance. So John will do what? John is reducing the insurance risk towards 91,000. After that 5 years, the cash value grows to 40,000, lowering the insurance risk to 60 years. Because the insurance risk is being lowered, that's why at 100, you can no longer pay any money. And at 100, it's assumed that you no longer need any protection. After all, if someone live up to 100, that person, I haven't seen the person tried. So that is just a good explanation of what whole life insurance can do for you. Let's look at this example. There is a specific return of cash value benefit rider that can be added to whole life policy. If an exam question doesn't explicitly mention an insurer policy having a return of cash value rider or endorsement, it should be assumed that the policy in question doesn't include that rider. Of course, there is no return of premium rider in whole life. Please know that. We have talked about maturity at age 100. We talk about maturity at age 100. Everybody should know that. Whole life insurance premium. We say the premium is what? Fixed. The premium remains the same. It does not change. What you pay today is what you pay tomorrow until the policy gets up to 100 years. So let's now look at basic forms of life insurance, whole life insurance. We have talked about the type of what? Term life, where we say level, decreasing and increasing. Now, let's look at basic forms, that is forms of whole life insurance policy. Types, which means types of policies. We're now going to types of policy you can see in whole life. Please, just make sure you differentiate the two. Like we did in term life, we now talk about the policies in term life. since now we have been talking about whole life, we are going to talk about the forms or the types of policies you can see in whole life. So whole life policy provide a fixed level death benefit or permanent protection with a cash accumulation features. It is characterized by what? Fixed level or predetermined premium for life up to age of 100 years. For insurance policy, insurance company to carry a risk up to 100 years. Haven't they tried? To me, they have tried. You know what it means to want to write policy? You go to somebody, say, please, I will carry all my problem, put on your head. I'm going to be paying you premium. Because that is what the contract is all about. We carry all our risk. You go to insurance company, say, look, take risk, manage it, tell me how much I'll be paying you monthly. The insurance company will say, you pay me $300 every month. And the insurance company will carry all the risk and you pay $100. That's exactly what it is. So for them to carry it up to 100 days, they have tried. They have tried. Then the one you go, they say, oh, this risk, I can't carry it up to 100 years old. I'm going to carry it to 10 years old. 10 years, you have to come, we negotiate the contract. If the contract is negotiated at 10 years, the money you are paying me now is not what you're going to pay me after 10 years. So that is term life insurance. Life insurance will say, no, I'm going to carry the load up to 100 years. At 100 years, my assumption is at 100 years, what the premium, the cash value generating from your policy will be equal to the death benefits. So come, let me carry it. I will carry the load. So that's exactly the difference between the two. So the policy cash value increases with each premium payment. The fixed interest rate is paid on the cash value, which is in traditional policy is also fixed for life of the policy. Therefore, the cash value built of whole life policy equals the face amount at age 100. The contract also includes non-forfeiture option or values if the policy owner wants to surrender the policy. Surrender value, which is a non-forfeiture option in cash value. In whole life policy, meaning the part that's going to the cash value, you're going to get it back. And they are what? Tax-free. They are tax-free. So, although it's presented to the whole life policy as calculated, let us not go. Let's jump distance, man. All right, let's look at the different forms of whole life. Number one, straight whole life insurance policy. This is where the confusion will start. So pay attention. Whole life, they have different forms. The difference of forms of whole life. There are three common most types of whole life insurance. One, straight whole life. Two, limited pay whole life. Three, single premium whole life. Please, this is where the confusion starts. So we're talking about whole life. Remember, all along we are talking about whole life, describing the policy, the cash value, and all. Now we are diving into different forms of whole life, and those different forms of whole life are the different policy types, not insurance type, policy types you will see in whole life. So those policy types is what we're going to describe now. They are three. Remember, in term life, they are three. In whole life, they are also three. So that's what you have to know. So that if you see them, you know where they belong, whether they are term or whether they are whole life. The three types of policy in whole life is what? Straight whole life, limited pay whole life, and single premium whole life. So these are the three policy types in whole life that we are going to discuss now. Any confusion? Any question?
No, go ahead.
All right. So we're going to start from the first one. The first policy types in whole life, straight whole life insurance policy. Remember, we have three: straight whole life, limited pay whole life, and single premium whole life. All these are policy types in whole life. Remember, in term life, we have three also. We have what? Who can name the three one in the whole?
Yes, we have
Increasing and decreasing.
we have increasing, decreasing, and leveled.
Correct. That is the types of policy in term life. Now, the types of policy in whole life is what? Straight whole life, limited pay whole life, and what? Single premium
That's single
whole life.
premium whole life.
Good. So I want us to go in this way so there will be no confusion.
The first whole life, does it have another name?
We're going to see it. We don't want to jump. It's called ordinary. We're gonna see it.
Okay.
Yeah. So, but I want all of us to follow it so that we not miss anything. Because this is where we get the confusion.
Okay.
Yeah. So first of all, we have identified that we have three policy types in whole life, of which we said they are straight whole life, limited pay whole life, and single premium whole life. Now, let's start to describe the straight whole life, the first one. We said is a basic form of whole life insurance, so straight whole life, also known as ordinary whole life. So straight whole life can be called ordinary whole life. So if you have your pen there, you can equally circle straight whole life. That is the first one we are taking on. It can be also called ordinary whole life. So if you go to an exam, you see straight whole life, they are talking about ordinary whole life. If you go in the exam, you see straight whole life, they are talking about whole life policy types. So these are the things you have to know. So straight whole life insurance is the standard definition of whole life insurance as described up to this point. So what they're saying is all those grammar, all those things we have discussed since morning as characteristics of whole life insurance policy, we are indirectly talking about straight whole life, which is what we call ordinary whole life. Now, whole life insurance that provide permanent level protection with level premium from time the policy is issued until the insured's death or age 100 is the straight whole life. This
Yeah.
huh?
So sorry.
Go ahead. Anybody say something? All right. So remember, we have described this whole life that it has a fixed premium, stretch premium, level premium, not cash value already determined, has a cash value growing up, death benefit known, face amount, which is the cash face value, or the death benefit known. We have described all those. So we want to attach it to these different policy types. So whole life that provide permanent life protection with level premium from the time the policy issues until insured death age or age 100. The continuous premium or whole life plan is characterized by what? Level of fixed premium, as long as the contract remains in force. So they call it straight whole life because everything is level, everything is fixed. The premium in particular is fixed. The cash fixed face amount is known. The amount you are paying today is what you're going to pay throughout the life of the policy. So that's what straight whole life. And whenever you are talking about whole life, you are talking indirectly referring to the first policy type, which is called straight whole life. So therefore, most of the people who are buying policies today, what they're buying indirectly is straight whole life, or what we call ordinary whole life. Is that clear? So let's go ahead and look at the exam tip. It said, unless explicitly specified otherwise, it should be assumed that any exam reference to whole life insurance is referring to straight whole life insurance.
Okay.
So you can see there's something you can notice here, that anytime they are talking about whole life, they are talking about that first one, straight whole life, which represents the whole life itself. So straight whole life can be also called ordinary whole life. So another name for straight whole life is ordinary whole life, meaning all the things we have been describing before about whole life, we are indirectly describing the first type of whole policy type called straight whole life or ordinary whole life. So whatever we have been describing since applies to straight whole life or ordinary whole life. So I think we'll go to the second one, which is called limited pay whole life. That's what we're gonna go now. Limited pay whole life insurance policy. So there may be changes in this one. Whatever we know since we have been talking since our whole life is what is stress whole life or ordinary whole life. Now let's go to another type of the policy that you can see in whole life, and that another type is what we call limited pay whole life insurance policy. Remember, we have 3 of them. We have done the first one, stress whole life or ordinary whole life. We are now going to come on what? Limited pay whole life insurance policy. I want you to look at this word, limited. That will guide us in getting it. So the advantage of this type of whole life insurance policy is that it allows the policy owner to cease paying premium. What whole life policy generally, when do you think you cease paying premium? At what
100
age?
years.
At
100 years.
Good. Now, limited pay whole life insurance said the advantage you have in this type of whole life is that it allows policy owner to cease paying premium after limited payment period. It's no longer talking about 100 years at age of endowment. It's not talking that you can stop paying premium at a particular time specified, which is limited pay whole life insurance policy. So at that point, the policy entirely paid off for life and no future premium are required. However, as with stress whole plan, the policy matures or endorses at age 100 or 4. That's stress whole life. A predetermined level premium for limited payment period characterizes a limited payment whole life policy. So this one is just like term life, where you can say at this particular age, I will stop payment of premium. Does your policy terminate then? At that point, you no longer have any policy premium you are owing. You have paid off the policy. The policy is paid off. All right, let's use your mortgage payments. When you buy a home, some people will say we choose 15 years mortgage pay, 30 years. Some people may go ahead because they have the money, they can choose 10 years. So what it means at 10 years, you pay off the home. Another person decide to pay, is paying off at 30 years. Another person say pay off 20 years. Some say pay off 15 years. So for limited pay whole life insurance policy, you determine when you pay off the policy. What it means is that the time you pay off the policy, by that time, what happened? The policy be like, the policy has stayed up to 100 years. And then after that, you no longer be paying any premium because you have paid off the policy at your own choosing a year. So that's why it's called limited pay whole life policy. Any confusion? Any confusion? I think everybody understood limited pay whole life insurance policy. All right, so we go forward. So this limited whole life policy, look at what I highlighted. That's what you get to know to identify it. Unlike term life insurance, it's as such, you can pay 10 pay life, 20 pay life, 30 pay life, or life paid up to at age 65. You can actually determine in the contract at what age you want to pay off. You can say, I want to pay up at age 65. They calculate it to you. You can say, I want to pay up at 55 years. They calculate it for you. You pay it. You still have your whole life. You still have the cash value build up. What happened when you use 10 pay life and what happened when you use 65 pay life? In types of premium and cash value build up. What happened at 10 years? You pay the same premium you choose to pay, and the maturity will become so fast. The cash value yielded become more to 35 years than to 65 years. It's the same thing as applied in straight whole life. If you pay straight whole life monthly, your cash value takes years to start build up. If you pay annually, your cash value starts on time, maybe about 2 to 3 years to start building up. If you pay lump sum, what happened? The cash value starts immediately to build up.
Immediate.
So you can see the difference.
Oh
So
my God.
even with just telling you this, you can see that the next type of whole life we're going to see, which is a lump, is we build more faster. So in all and all, you can now see that straight whole life build less cash value. I mean, the time it takes straight whole life to build cash value will be less than the time you're going to take limited pay whole life insurance to build cash value. Limited pay whole life insurance, we build cash value faster. You understand? I hope everybody is getting it. All right.
Yes, yes.
So if you look at this, just look at this graph. Look at the graph. Premium paid for 20 years. This is limited per life. The person choose 20 life. Remember, when you are describing term life, you use 20 term. When you are describing whole life, limited whole life, you use what? 20 per life. Please remember that difference. 10 per life means that 10 years per life, 10 years you finish paying up the premium. 10 years, the policy matures. 10 years, the cash value is equal to the first amount. 20 years, the same thing. 30 years, the same thing. Somebody can say, I want to do it, I want to pay up to my age of 65 years. So just like as we pay off our home, that is exactly what it is. Somebody decides to pay in home in 15 years. Some pay off home in 30 years. So it's just the same. But remember one thing, those who pay faster, pay less. I hope everybody understood that.
Okay, those who pay faster, they pay less.
Of course.
Okay.
If you are paying annually, you're paying your policy annually than somebody who's paying monthly. The person who's paying annually pay less than the person who pay monthly. You don't know? Remember, at any payment, there's always administrative fees attached to it. Yes. At every payment you made to your auto insurance, to your home insurance, to your life insurance, there's always administrative charges attached to that premium. So if you pay monthly, which means every month, that administrative charges will be attaching to your premium. But if you decide to pay annually, the administrative charges will be only once. You covered 1 year already. So when you pay a policy annually, you are automatically paying less than when you are paying monthly. It's the same thing as your auto insurance. It's the same thing. When you buy auto insurance, your agent will tell you if you pay monthly. If you pay monthly, pay so amount. If you pay every 6 months, pay so amount. If you pay 1 year, pay so amount. Is that not true? Who have experienced that?
I have. Yeah, correct. They pay less.
Yeah.
Yeah.
When you pay annually, you pay less. When you pay 6 months, you pay less than when you pay monthly.
Yeah.
So that is how it is. It applies to every insurance policy. So in your life insurance, if your agent is encouraging you to pay annually, he's want you to pay less than when you are paying monthly. So that is the implication of paying monthly and paying annually.
Annually.
Yeah. So you pay monthly, you are fine. You pay annually, you are fine, but you pay more in monthly than you pay annually. So it's just the same thing with auto insurance. In fact, that was last month when I paid for our auto insurance. I now calculate. I told then I did the calculation, because what you do when you have this license, you can equally do your auto insurance, your home insurance by yourself. You can do that. You don't need any agent, you don't need anybody. You can just go online and get it. And the good thing about it is you paid commission on it. You pay commission on it, or your own insurance, your own home insurance, your own auto insurance. You become your own agent. If you become your own agent, you will do that. You can do for your friends. You can refer to your friends and your families are there. They pay if they accept the policy given to them. The insurance company will be paying you the agent fee. They're supposed to pay other people. So there's a lot of way to get extra $1 if you
Okay,
want.
don't worry. You will teach us that. You will teach us.
There's a lot of ways. There's a lot of way to get extra $1 here. No, that's the truth. I did my
Yeah.
hand. I'm getting the benefit.
Okay. Okay.
All right. So let's look at payment for these policies are higher. Look at this. This man is the red line is paying. You see, he started paying at maybe 27 or 28. All of them started at 7 years. This one, 20 pay life, which means he used 20 years to finish up in
to finish paying.
This one paid up to the age of 100. You see that this person that finished, the blue one will pay less than the person that paying up to 100.
Up to 100.
Yes. So that is applied to every insurance issue. So premium for these policies are higher than for the straight life policy because they are paid for only limited period, e.g. 10 years, rather than age to 100. You see it? Once payments are complete, the policy is paid up for life, meaning no additional premium are due. Upon the insured's death, the death benefit will be paid to the designer's beneficiary. Although the policy is paid up early than a traditional whole life policy, it will not mature until age 100 since the contract has been predetermined. Since the premium for this policy are higher than those of a traditional whole life, they are often said to have a more substantial savings element or greater emphasis on saving than traditional whole life policy. You can see that.
Yes.
Premium is higher, yes, but you are benefiting by paying higher premium because the savings element are higher. The target of whole life insurance is to be part of that savings element. And on that savings element, you want to increase the efficiency on it. You want to make it more better for you so that you can, this person that paid within 20 years, he can go there and get money, good money to do whatever he want to do. But somebody paying up to 100 years. Yeah, that's the truth. Yeah. If you open policy for your little baby now, when that baby turn 30 years, when he come out from college, work for some period, he want to buy his or her home. That baby don't need to go to any nonsense bank to go and say, give me,
I need loan.
What do you need it for? You begin to pay 7.5%, 20%, 30%. No, go to your policy. A baby that have $1 million, $2 million policy, which is very low, at 30 or 40 years, can comfortably go there and get up to 500,000 to 600 to buy a home. And be paying 2%. And who are you paying 2% to? To yourself. Come on. People will say the other color they just go they get their money, go holiday. Why won't they? Because they're making use of the law. They enjoy themselves. They don't stretch themselves because all those things are easy, but we do not understand. Sometimes I'll be saying, had it been that they can take me and my wife back, we now begin to have our children.
And change the hand of the clock.
No, honestly, I just felt like saying we are just starting today to have children. Each of them will get up to $33 million life insurance policy. I tell you the truth. Immediately I hear, hey, I go.
Just go and get a policy.
No, I'm telling you the truth. I'm telling you, I will not waste time. I won't waste time. Instead, even if I don't change my car, I don't mind. I don't mind because I know what my plan is. And remember, when you get it at that age, you are the policy owner. You are in control. You can do anything on that policy. You can take a loan. You can make a withdrawal from that policy. It's your own. You manage it. Remember, who pays the piper, they take the tune. You are the policy owner. You decide what happened at that policy.
You have absolute control.
Except until the point you hand over the policy to the child. Probably when the child begins to earn money, begin to have some income, and can be able to pay the premium. That's when you transfer the ownership to the child. He now becomes the insured and the policy owner. But before, the child was the insured and you are the policy owner. All right. So, single premium whole life insurance policy. We have 3. We have done all the two. Now, single premium. That's the last one type of policy. I assume that everybody understands the 2. Now we're talking about the single premium, which means this premium you paid at once.
In
It's a
lump sum.
lump sum payment. Single premium whole life is the most extremely form of limited pay life policy. The policy is characterized by a lump sum or single premium payment. The policy is fully paid up upon the payment of a lump sum premium. Some single premium plan exists which require 2 premium payments, such as dual premium policy. So you can do single premium, you can make it a dual premium policy, which means you are paying the premium only twice. But if you pay lump sum, means you write the policy today, you ask them you want to pay lump sum, you pay lump sum immediately. So, common traits of a single premium whole life. Remember, when you overfund your policy, that policy becomes a MEC. I hope everybody understood that. When you overfund your policy, the policy turns to a MEC. When you overfund the policy, it loses the insurance characteristics. It now becomes an investment. And when it becomes an investment, you begin to pay tax on it. So let's look at the common threats, that is things that make single premium whole life difficult. One of them, and you can, if you pay a single premium, you can start having immediate cash value. You create immediate cash value. That is one of the advantages. 2, part of the premium used to set up the policy reserve. Of course, you have the policy reserve will be there because the amount you paid, part of it will go to policy reserve. Over time, the policy owner will pay less. As you continue, the money continues to grow, you pay single premium, what means that at the point of 100, you're no longer going to pay anything. Of course, what happens? You have paid the policy. Now, one thing that people get scared of about single premium is what? Single premium life is defined as modified endowment contract by the IRS. This is where attention is. Because it's what? Modified, when you overfund your policy, which is something like paying a single premium, it may turn off to modified endowment contract. And if it's a modified endowment contract, the element of life insurance that is there is taken off. You are not seeing it as an investment. So a single premium whole life policy is naturally the most expensive whole life policy. However, over the life of the contract, the single premium life policy is least expensive compared to straight whole life. Initially, single premium is expensive because you are paying everything at the same time. But over time, you see that it's the cheapest. It's the cheapest. Just like somebody who pay annually, his own will be cheaper than somebody who pay monthly. Somebody who pays every 5 years. His own will be cheaper than somebody who pays every 1 year. So the more you pay, the cheaper it becomes, just like in your auto insurance. If you pay monthly, you pay more, but you will see that you are paying less. Averagely, you are paying more. If you pay annually, you pay less. Averagely, you pay less, but when you are seeing it, it seems to you as if you are paying more, but indirectly you are paying less. So I want everybody to take note of this. This MEC, you will definitely going to see it in exam. It should be noted that the IRS considers single premium policy to be a hybrid of a living investment and life insurance. Look at it. And this is what IRS don't want to see. When you pay your policy single premium, it's a hybrid of living investment and life insurance. I told you that life insurance is not an investment, as described by the insurance law. It's not an investment, but indirectly inside it is an investment because of the saving element. So based on that, IRS consider it not a good thing for everybody. In fact, they are against it. They kick against it. So they call it MEC, Modified Endowment Contract, MEC. In that case, that tax-free death benefit that you benefit when you, on the cash value policies, what happened now? There is a restriction on it. You'll be paying tax on them. Remember, death benefits is tax-free. The cash value you will take if you surrender your policy is cash-free, is tax-free. But when you overfund the policy, it now becomes modified endowment contract. That tax element, that tax element you enjoy on them as an insurance policy is now removed. You now begin to pay tax on them. So that is the only difference. And who wanna remove that tax advantage? Nobody wanna remove that tax advantage. So everybody is avoiding what? Everybody's avoiding to make the policy a MEC. Of course, I have this experience with one lady. He called me. She said she paid 7-pay. When she paid 7-pay, she added another money on that policy. However, she already paid 7-pay. She added another money. After about some months, she called me and said, "Oh, they have not withdrawn the money." She added. I said, "What? They have not." I didn't know that she have done 7-pay. I was not the person that read the policy. I said, "Why?" Say, "Yeah, they have not withdrawn the money." I said, "Did you call them?" I now forced her to call them. When she called them, they tell her that she have already paid 7-pay, whether she want to make her policy MEC. She did not understand what MEC is. She called me back to ask me. I said, "Please tell them no. If you say you want to make it MEC, who is losing? You? Because what is coming at the cash value, the thing you are getting at the cash value, that increase in cash value will be taxed on. Because they now become an investment portfolio. It's no longer a life insurance portfolio." So that's what everybody should know. That's what you teach your agents. I mean, your clients, please. All right. I think we already know this. We know that every life insurance policy, every cash surrender, death benefits, all of them are tax-free. But if you overfund your policy, if you make it MEC, they are no longer tax-free. They're going to tax you on it. So I want us to. All right. All what we have been saying before is what? Traditional whole life. And in that traditional whole life, we have 3 types of whole life, which we've just finished. Now, let's look at non-traditional whole life insurance. You see, what I said, this is with all this, you see that become confusing.
Yes.
So now, what we have been saying before is what? Traditional whole life. And those traditional whole life have many types, 3 types of policy attached to them. Now, let's go to non-traditional whole life insurance. So these are other whole life plans that, remember, all this is a policy. The only type of insurance we are describing now is whole life. And in whole life, we are seeing all those policies attached to them. The first part is the traditional whole life, which we have described 3 types of policy types. Now we are coming to non-traditional whole life insurance plan. That is the types of policy attached to non-traditional. Premium charge for these plans are less than for straight life. When we hear straight life, we're talking about the traditional type. For instance, if you are paying in 3 years, you will see that the money that will be attached in straight life will be less than what is going to see on the traditional. We're going to see them. So cash value accumulates with each premium payment. Insured who needs permanent protection but cannot afford the higher traditional whole life insurance may buy these types of policy. So non-traditional type give you less opportunity, more opportunity to get less because is somehow cheaper and affordable than the traditional. Now, one of them is modified whole life insurance. Modified. Remember, modified endowment contract is not the same with this. Modified endowment contract is different scenario altogether. When you overfund your policy, it loses the tax benefits, the tax advantage you're getting from insurance policy. It becomes an investment, is taxed. That's modified endowment contract. Now, modified whole life insurance. You see this one every time. This one is what part of non-traditional whole life insurance, modified, and it's cheaper. When you cannot be able to afford the straight whole life, you can go ahead and get modified whole life, where you you design based on what you can afford. So modified whole life is a whole life insurance policy characterized by initial premium that is lower. Remember, this particular one confuses everybody. Please. So if there's a way you can write it down, and it's one of the ones you see in the exam, modified whole life, because it's confusing. I'm telling you. I should confess it's confusing. This one, modified whole life. You'll see it in the exam. You'll be thinking whether it's modified whole life or graded premium whole life. So this non-traditional type is most times come to the exam is confusing. So let's look at modified whole life. Remember, we say it's cheaper because it's not traditional whole life. Modified whole life is cheaper. Initially, your premium will be lower than the straight whole life. At the beginning, the premium is cheaper. The policy owner will pay a lower flat initial premium for the first few years compared to the straight life. After this time, the premium increased to an amount higher than the initial straight whole life premium would have been. Initially, the premium is lower than what the straight whole life, but after a few years, the premium will go up to an amount that is higher than the straight whole life would have been. At first, you pay a very low premium. After about a few years, the premium increases very high, more than what it will be. So that is modified whole life. Modified whole life, initially you pay a lower premium. But after some years, the premium will increase. It will increase to a point that it becomes so expensive. That's what modified whole life. But they tell you it's cheap because it's cheaper initially. But with years, as years go by, it increases. That is, the premium is not fixed. The premium is not level.
But at the point of getting the policy, will they tell me that it will be higher at some point?
Of course, you will tell, now that you're becoming an agent, you will tell your clients that, look, this is what's going to happen if the client chooses modified whole life insurance policy or chooses non-traditional whole life insurance policy. In non-traditional whole life insurance policy, if your client chooses modified whole life insurance policy, you will have to tell him that, look, oh, this is cheap, very cheap. This is a cheap one. It can also do to you what straight whole life will do. The only advantage it has is that it's cheap at the initial time, but with time, it will be higher. The premium you are going to pay will be higher compared to what you pay in straight whole life. So if you tell your client like that, it's left to him whether to choose straight whole life or to choose modified whole life insurance policy, where initially you pay low. As time goes on, you increase. You pay more than what you pay in straight whole life. So is that clear?
Yes.
So I will want, if you have paper, just jot it down, because if you think it's on your head, you will not get it. That's the truth. Because this is, most times, it gets people confused. So let's go to, right, let's look at this. Say, the premium increase following the initial period. the premium increases following the initial period. The premium changes once and then remains level for the life of the policy. At the first point, the premium increases from the initial period. Initial period is very low, very small. Then with time, it increases. Go ahead.
No, I do not understand what you said.
Initially, the premium is very low, very low. Remember, in whole life, we said the premium is fixed, which means what you are paying now is what you are paying throughout the life of the policy. Is not what we said?
That's for straight whole life.
First whole life, correct, you got it. Which is the whole life we are talking about. Now, we are coming to non-traditional whole life. We are coming to modified whole life. We say what happened? At the point when if you buy the policy, initially the premium is low. You pay low premium. Then with time, the premium will increase to a point that will be as what you will pay if you have bought a straight whole life.
Yes.
Now, let's look at as they go ahead to do the definition, they said the premium you pay will be initial premium from 3 to 10 years. From 3 to 10 years, you are paying initial premium, which is a lower initial premium that increases to an amount higher than the traditional straight whole life.
Okay.
So,
Is that not Is that not like term insurance?
No, it's not like term insurance because term insurance is what you have to, it will term, then now is another contract altogether. You renewable. This is not renewable.
So what do we do when it becomes higher than what we should?
What you do when it becomes higher because it's a policy type that you choose. Remember, you see other ones you choose, you now decide to choose this one.
Okay, supposing we can't pay when it is too high for us, what will happen?
If you can't pay when it's too high for you, the policy will terminate and they will pay you your cash value back. You understand?
I do.
Yeah. If you cannot pay, the policy will terminate and they will pay you your non-forfeiture cash value because you have surrendered the policy. So, but however, it's a choice that somebody make. You cannot see straight whole life and choose this one. However, will some people want this one? Yes, some people want it.
But what if they don't know?
You're gonna teach them.
And that's why I asked that question. I hope the agent will tell the person that look at how it runs, not at the middle of the something. You say, what is going on here?
Yes, of course. Of course. In fact, most times when you even write a policy, you will not bring this one to the table of the. If you want to go broad,
that would be better.
After the need analysis, you already know what that person needs. If what the person needs is this, you're gonna bring it to the table. But if what the person needs for after the need analysis is not this, there's no need to bring this to the table. But are you gonna know it? You're supposed to know it as an agent. You're gonna know it to pass your exam and know it for knowing that it's to, so that somebody cannot say this is the reason why I don't want to have policy. There is a one good for everybody. You understand?
Yeah.
There must be one applicable to everybody. So somebody cannot say I don't want to have policy because it's one choice. No, there's a lot of choices you can make. Some people may not have money within the first 2, 3 years. They pay in a lower premium, initial premium. Then after that 10 years, probably maybe their bank will break. They will start to get more money and pay more to the policy. So it's choice. So modify whole life insurance policy alter the method of which premiums are paid. You see, it alter the method in which premiums are paid. It alter the method through which premiums are paid. Our normal premium is straight life level. You pay the same, nothing happens. But modified whole life, the word modify will show you that it's different from all what you know. So it's a choice you make. If you decide to go to modify whole life, where you pay a premium initially from 3 to 10 years, pay a very low initial premium. Then after 10 years, the premium increases. Then it's left to you. But is your policy going to terminate? No. The policy will not terminate as far as you are paying your premium. So any question? I know this one.
It's confusing, sir.
Yeah, but you have to know. You have to know it at least to pass your exam.
For a layman, it's very trickish.
Uh-huh.
It's very trickish, not confusing. It's trickish. How
Oh.
can you lure somebody into this kind of expenditure? No.
But remember, they're not forcing you. They are giving you alternative.
I'm giving you alternative. If somebody doesn't explain this to
in detail,
somebody to understand it,
exactly.
you can pick it up thinking that you are doing yourself good. Okay,
In
I can manage
favor.
this, I can manage this.
You
And
know,
at the end of it, you see that you are not able to continue and they will term your policy. It's not good.
you see,
Let's go.
when I was growing up, let me tell you guys one story. When I was growing up as a boy, as a small boy, my dad will always tell me, Ifeanyi, don't go closer to something that is cheap. My dad will always tell me, do not go closer to anything that is cheap. That if I want to go to anything that is cheap, I should look beyond it. So most times, cheap things will lure you to enter it, and by the time you know it, become
and you will regret having them.
No, I'm telling the truth. If you want to go and buy something now, you go to buy something, they tell you that this product, this one is $100, this one is $500. They will tell you, anyway, take $100, serve the same purpose. Now lie, something is there.
2 days, it's gone.
Something is there. So most time, cheap things will bring you into it, but what you buy in cheap things will be, what you're gonna see in cheap things will be more than what you spend on the things that are expensive. So always, quality matters. Quality matters.
It does.
So quality matters. People will be lured into this because it's cheap. At least for the first 10 years, I'm gonna pay small. Yes. What about after the 10 years? What happened? You understand? What about after the 10 years? What happened? So people should understand that cheap things also are not good for us. It doesn't last, my dear. Somebody says cheap things doesn't last. Cheap things doesn't last. So some people will run into it. Oh, no, believe me. Do some people have it today? Yes. Do some people have term life insurance? Yes. Because what is cheap.
That one, that you understand what it means by the name itself.
So cheap things, generally cheap things, if you want to do cheap things, go twice. Look for it twice. Bend down, look
Think about it.
Think about I'm telling you the truth. Think about it, otherwise you enter one choice. So we're gonna see another type now. We're gonna see graded premium whole life. Graded. All these are non-traditional whole life insurance. Modified whole life. Of course, everybody now knows what modified whole life is, because you're gonna see it in the exam. Modified whole life. Why? Of course, let me ask this question: why do people make choice of the purpose of modified whole life? Is to make the initial purchase of permanent insurance more accessible and more attractive, especially for individuals who have limited financial resources. More accessible and more attractive. So it's more accessible, it's more attractive.
I don't even see the way you do. More accessible at the beginning, but in the long run, you start paying higher premium.
But how many people do you think would think about at the long run? People think about now immediately. Oh,
I have.
Let me manage it for 3 to 10 years. I'll be fine.
Okay, 10 years is gone.
And they will get it. And before you know it, 10 years is gone.
You begin to cry.
So, as mentioned previously, any individual who are seeking permanent protection but cannot afford the higher traditional straight whole life premium required will buy this type of policy. Of course, if you cannot afford the initial high cost of traditional straight whole life, you can go for this, where you get it cheaper at the beginning from 3 to 10 years before it increases, and it increases past straight whole life. So now let's look at another one, another traditional, a non-traditional type called graded premium whole life. A graded premium whole life plan is a contract characterized like a modified life. So we now know what modified life is. The graded is the same. What happened? By a lower premium than whole life in the early years of the contract. However, premium increases annually or every year during the initial period. Thereafter, once it has increased to its final premium, an amount higher than the whole life premium, it remains fixed for life. The premium for these policies are predetermined, but are not level in the traditional sense as they would be in the traditional straight whole life or limited per whole life plans. So this one is another one. We are even talking about that one. This one maybe somehow better. I would prefer graded premium whole life to modified. You know the reason? In graded premium per whole life, it will increase, the premium is increasing every year. At a point, reach a point, it now becomes fixed. Premium increases every year, annually. The premium begins from being small. It's now every year increases. Every year increases. Every year increases to a point now it becomes fixed. It becomes permanent. The premium does not decrease or increase again. You pay it throughout the life of the policy. So you can see that this one is better. You know why it's better? Already you have known that every year you're going to see another premium. Every year you're going to see another premium. So if you left to me the two, I will take graded premium because this one already on my head. And this one is say 3 to 10 years before the premium now increase to a level you wouldn't know. But this one already know that every year it increases. It increases annually. Annually, it increases until a point in which the point it can no longer increase. So that's
this one is better. This is better.
Yeah, that's
To
graded.
me, graded is better than
No, graded is to me. I would pick graded.
modified.
Yeah, modified, because this graded, your mindset is already there. That's every year you are paying new money. Yeah. So that is a graded. So modified versus graded. So non-traditional, how many do we have? Modified and graded.
And graded. Yeah.
So who did not understand it? Let's look at the characteristics with this drawing. With this graph, it said death benefit on the modified whole life, death benefits level. Of course, you know the death benefit. Graded, you already know the death benefit, how much you bought, the first amount, the first value. Now, the premium, predetermined 2 fixed premium period. What's the 2 fixed premium period? Initially,
it's low in the initially, then at some point it goes higher.
Goes high. All right. So the graded predetermined more than 2 fixed premium period. So more than 2 fixed premium period, which means annually it increases annually until you get to a point it now remains fixed. So that's graded whole life. Now, cash value. Yes, it's predetermined, it's tax deferred and guaranteed. The tax value, the cash value is guaranteed. Of course, all of them whole life, they have cash value. So cash value is the same. Policy loan, can you take loan from them? Of course, you can take loan from them because they're generating cash value. Partial withdrawal or cash value. Partial withdrawal. No, to receive cash, it must be borrowed. All right, you see? So this is what you have to know. See what you have to know on this non-traditional. In non-traditional or like traditional, you can walk in there to withdraw some money. In non-traditional, you cannot receive cash. You cannot partially withdraw your cash value. Even if so, your cash value is there. It must be borrowed.
And it's my money.
Yes, you must borrow it. So these are the conditions. Is there any surrender charges? Of course, no. There's no surrender charges. So of course, in stress whole life, there's no surrender charges. All right. So, so we did the traditional, we did the non-traditional. Enhanced whole life insurance, economic stroke extraordinary life. This is enhanced whole life. An enhanced whole life policy, also referred to as economic life or extraordinary life, is low premium participating permanent life insurance policy. Low premium participating life insurance policy. Where do you have participating policy? Where do you have participating policy? Which type of company says participating policy?
Mutual.
Which type? Mutual. All right. Mutual say participating policy. So where do you think you can see enhanced whole life insurance policy? It's a mutual company because they say participating policy. So let's look at indeterminate premium whole life policy. This one, you may not see it in the exam. Indeterminate premium whole life policy is a type of whole life policy that offers a low initial premium for a specified period. After that period, you see why you may not see this type in the exam. What you need to know, just no graded, no modified. That'd be fine. Yeah.
Okay. Okay.
Because if you look at indeterminate premium whole life, it looks like graded. So current assumption whole life, CAWL, interest sensitive whole life. All right, we should look at this interest sensitive whole life. Current assumption whole life also refers to as what? Interest sensitive whole life and excess interest whole life is characterized by premium that vary to reflect the insurer's charging assumption concerning its debt, investment, expense factors. However, interest sensitive products are also provided that the cash values may be higher than the guaranteed level. Why are they called interest sensitive whole life? Interest, the cash value is expected to guaranteed to be higher than the guaranteed interest. The cash value is higher. Will insurance company give it to you? Of course. And what will happen? What do we expect? The premium will be higher. Because they cannot dash it to you. If you go for current assumption, interest sensitive whole life. This one will be mostly for if to say you are somebody is going to pass and there's other person looking at investing some money, you can go for it. So if the company underlying debt, investment and expense assumption are more favorable than expected, policy owner will have two options: lower premium or higher cash value, which could result in higher debt benefit in later years. So this one, structure this one based on what you want. Generally, life insurance actually is what you want. But if you don't know it, somebody want to write policy for you, the person, just write 200 for me, write 200. But you need to know it. If you know it, actually you know it, you can begin to point out structure to what you need. You can want interest sensitive whole life. Of course, you want it. But what is in there? You're going to find out, make sure that when you want more cash, you want more premium. More premium be paid.
I did not understand this interest sensitive whole life.
It's
I
basically,
don't understand your explanation.
yeah, I'm gonna still do it. We are on it now. You're still gonna. What I want you to understand, just know that when you want to pay, when you want to make more cash value out of it, they are expecting you to pay more premium. Just know that before we go in. The assumption in whole life also refers to interest in whole life. What? Have excess interest whole life. Excess interest whole life. Excess interest whole life. What is about that excess interest whole life? They're talking about the cash value. Because you are paying attention more on the interest, which is the cash value. It will be characterized by the characteristics of that is that the premium you're going to pay will be more compared to the premium you're going to pay to other. Because you are expecting more higher cash value than the guaranteed cash value. You go if you want more cash, you go for interest sensitive whole life. If you want more cash value, you go for interest sensitive whole life. You make more money out of it. But however, remember, you cannot just getting like you have to pay more premium. So is that clear?
Yes. You say you use more cash value.
If as far as you're going for interest whole life or interest sensitive whole life, you are getting more cash value. They call it current assumption whole life, CAWA, or interest sensitive whole life, means that you are going for more cash value.
But
which
you
is
pay
the
higher
increase.
premium.
You're gonna pay higher premium. Because this particular policy do what? It guarantee you a better higher cash value than the specified guaranteed level. For instance, if our whole says whole life guarantee a cash value of $100, this one guarantee a cash value of $300. But however, you have to, if you want to pay, it means that your premium will equally go to co-op. So it's for to higher value. The interest rate call for higher value. Look at it. It's a which would call for higher premium than that at the policy issued. You cannot get it cheap. You have to call for higher premium. The policy owner may then either pay the higher premium or reduce the policy first amount and continue paying the same premium. When the when the higher premium is higher, the first amount, for you to reduce the premium, you have to reduce the first amount. If you want to buy 500,000 and you ask the agent, how much should I pay? The agent say you're going to pay 4,000 every month. You say, no. Can I come down to $200, 200,000 policy? You go to 200,000 policy, probably it becomes 1,000 premium. The interest sensitive whole life will give you a higher premium, higher cash value. So, but if you really want to get a higher cash value, you can still go for it. So, I think we're gonna leave it. Let's look at low premium type. The low premium type includes what? Indeterminate premium that is initially low. It also contains a redetermination provision that allows the insurance company to refigure the premium after a specified period. Higher premium type. With the higher premium type, the initial premium is relatively high. It includes an optional pay-up provision that allows the policy owner to cease paying premium once the policy value are sufficient to pay up the contract. So, equity index whole life insurance. I want everybody to pay attention whenever you see equity index. Let me first of all talk about the word index. If you index your money, if you go to a bank today, you said you want to, if they will agree, let's assume you say you want to index your money. What it means is that you want to lock your money. You want to lock that money. You don't want that money to see anything called loss. You want the money to see only anything called gain. You index your money, you compound your money. Means what? Your money compounding, your money do not fall to loss, your money only react to gain. Is that clear?
Yes.
Yeah, when you say you index your money, it means sometimes they say index your money and compound your money. Of course, that is what is going on with life insurance policies or annuity policies. When you index, you compound. Because what happens is that the money from your cash value that are going to the money from your premium that are going to the cash value is indexed and compound. That is why the yielding increase. When it's indexed, it means that that money, if the market trend is low, it does not concern that money. The money will only react on the market trend that is higher, because he's gaining out of it. And when the market does not favor it, it's locked up. Does not open. It only open up when the market favors it to increase. Is that correct?
Yes, sir. So that means somehow it is related to annuity, index annuity.
Index annuity, index life insurance too. You can get index annuity, you can get index life insurance. Fixed index life insurance, you can get it. You understand?
Yes, sir.
Yeah, if you go for index annuity, you can equally go for index life insurance. So, can bank give you index opportunity? No. because if they give you, then you cannot be receiving 0.001%. You can't be receiving 0.00. I don't know whether the only me that is seeing 0.001%. If you concourse, IJ concourse, she don't understand. IJ, which area? Is it the index? I'm just explaining index.
Yes, the index. Yes, I didn't understand it.
All right. I just say index is when the account is locked. That account only react to gain. It does not react to loss.
So is it a good thing?
Of course, that's what everybody wants. That's
Okay.
why if you have annuity, what you have is a fixed index annuity. If you have life insurance, you are going for a fixed index life insurance.
Okay.
You don't want your account to participate in the loss. You want your account to participate in gain. If you have fixed index annuity, that annuity is there, that account is there. Whether market is going down, market is going up, it's not a problem. It's only react when market is going up to get more. And when you get more, you lock it up, waiting for when more will come. Then when you get more, and when there's a loss, you lose the one you get to start again. That's exactly what's happening in 401k. The 401k react to market trend. When there is loss, it affects it. When there is gain, it affects it. That's why if you open up your 401k today, maybe you see you have 200,000 there. You go tomorrow to open it up, you see 190-something thousand less. Now you go another day to open up, you see $210. Means that it has a gain. Because the account is not indexed. So
Okay.
then if you come to your loan, mortgage, and auto insurance, I mean mortgage and auto loan, they are reacting to index too. They compound. They're using compound interest on you. They don't bring in index. They bring in compound interest. You know, normally we know about simple interest, but now they are using compound interest. What is compound interest they are using? You pay this month. Let's assume you are owing to $20,000, and monthly, every month, they tell you to pay the least. Then the least becomes $500. You pay $500. In that $500, how many interest is there? Maybe around $350. The interest you paid. They take the interest, put $150 to your principal. Now, the one they put to your principal is a reduction. But because you pay $500, whenever the next month, what they're going to do, they are compounding both the interest and the principal that are remaining to give you a new charge. So it's come up to say you don't finish paying your auto loan. You don't finish paying the house loan. You continue to pay every year. You buy a house today, it's 500,000. By the time you finish paying that house, you have paid almost 1 million. Or even more than 1 million. So that is what is there. So how do you cut off being paid more? You make sure you put more money on the principal to cut off the compounding effect. That's the only way you can reduce, you can bring in the amount you're paying. The credit card industries don't want you to pay off your credit card. They will tell you to pay the least. The least may be $10. You are paying the least. You thought it's cheap.
Yes.
You thought it's cheap. It's not cheap. You are
Don't
paying.
know that it's not cheap.
So, but if you go and just dump in 1,000 there, you have cut off the whole interest they're going to make. If you have a home today, you decide to go and pay off your home, you will have cut off the amount they are going to make on your head. What they're doing, they're using compounding. Anyway, you're going to know all those when you begin the business. There's no need jumping into it. So, equity index whole life insurance offers the security of traditional life insurance while allowing interest earning tied to an equity index SP 500 without direct stock market risk. Did you see it? Without direct stock market risk. What is that risk? the risk of loss,
Inflation.
risk of inflation. Remember, if you are buying anything today, anything you buy 10 years ago, if you go there now, you cannot be able to buy the same amount you are buying it. It's inflation. So you are removed from from risk if you are indexed. So the policy guarantee minimum interest rates differs taxes on interest and provide access to policy loan designed to outpace inflation. What does it do when it's indexed? The inflation is cut short of. Because when inflation features are attached to your payment, you pay more. And there'll be no growth. The only way you can grow is to bypass inflation or to earn more than what inflation impact you have. If the inflation is 3%, you must make sure you're earning will be 4%. That's the only way you can grow. If not, you cannot grow. So it is designed to outpace inflation. When it's indexed, it's designed to outpace inflation. I think everybody is getting it.
Yes,
The-
sir. Yes,
These
sir.
policies blend term life insurance with investment features akin to universal life plan with death benefit based on choosing coverage and account value. We are going to still see more of index whole life insurance. India, we're going to see universal life insurance plan. We're going to see index universal life. So this is another type of whole life, equity index whole life insurance. That is where we're going to see universal life insurance. They have told you what they tell you there is the characteristics, what you see there. You have this element of indexing, and it works with what? SP 500. SP 500 is a mechanism in which interest growth is calculated. Most often it depends on this. When you say stock market is low or stock market is high, it depends on SP 500. So we're still gonna see it more. Alternative non-traditional life insurance products. I think it's almost 2 o'clock. 11:27. We're gonna stop here. So we're gonna finish it in the evening. Remember, we have I think 6 o'clock.
Yeah,
We have
6
it
o'clock.
by 6 o'clock. So we start 6 o'clock. We start by alternative non-traditional life insurance policy. But definitely, we're gonna be faster to finish up this one. To answer the question. So tomorrow we enter chapter 5. So we're gonna stop here. We meet again by 6 p.m. in the evening.
Okay, sir. Thank you so much.
All right. So you guys have a blessed day.
Thank you.
Thank you.